This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing Podcast. This is podcast 125. It is Wednesday, the 17th of April. For all of you that are on YouTube wondering what's going on, there are two new faces on the screen. My name is Peter Higgins. You can find me at Conquest 3. I've also got Jason at StealthServe on Twitter, Jason Needham with me here. And I've got Jamie Ward from Twitter as well. Jamie, hello, for the first time visiting us from Twitter Sphere and ShareScope and other places. Welcome, sir.
Thank you. Hello, Peter. How you doing?
I'm very well, thank you, mate. And Jace, you're going to say hello to people or not?
Yeah. Welcome, Jamie. Welcome, Peter.
The reason why we have
welcome, Jason. Hello.
and Jamie on the show is, unfortunately, I got a call from Phil Oakley telling me he was poorly on Monday, and our good friend couldn't make it tonight. And also, our effervescent, almost always, Henry Viola Hare was poorly as well, and he contacted me this morning, unable to speak, so he's not able to make it. And these two lovely gents have saved my bacon by volunteering for this. I'm not sure what they're going to call it by the time they finish with it, but it's normally described as a podcast, yeah? And they'll describe it as they wish after this experience. So here we are. We are going to introduce you in a few minutes to Jamie Ward, who's not been on here. He's going to tell you what his Twitter handle is, because I forgot to write that down in front of me when he introduces himself in a minute. But first of all, I'm going to just do a quick little recap of the markets, which have been extremely volatile since last Thursday. So we're going to go back to Thursday the 11th first. And the markets hit a new high, year-to-date high, not all-time high, but a new high of 8,044 intraday, and it was up 0.9%. And everyone's going, whoop, whoop, we're going to close at 8,000, and we didn't. We gave it up. But we finished up 71 points, and we finished up at 7,995 and a bit. And still good enough. Went into the weekend, and everyone's looking forward to Monday the 16th. The market's hitting that 8,000 and us having our first close in some time of 8,000. What happened over the weekend? Geopolitical indifferences, should we call it? And I'm not going to go into it anyway, but the politics of various countries dictate that there's always going to be conflicts and ongoing conflicts, and that's what's happened over the weekend. And what did we have on Monday? Markets went down significantly. Monday the 16th, FTSE went down 1.8%, hit a low of 7,793. So bearing in mind, on Friday we had an intraday high of 8,044. That's some point move in one trading day, or less than one trading day later. We closed down 1.8%, as I said, at 7,820. And basically, the markets were not sure what the next day was going to hold. And obviously, the US markets as well didn't do so well on Friday the 12th either, and didn't do so well on the 16th either. And then on the 17th, we opened up, and basically the markets decided to give us a bit of a reprieve. And today, markets have edged up a little bit, and we've closed up 27 points in the FTSE 100 at 7,847, having hit a low again of 7,798. So 0.35% is the FTSE was up. FTSE All-share was up 0.3% as well, closed at 4,273. AIM sitting at AIM All-share, sitting at 743 plus 0.66%. So it's still up and sitting above that support level of 700. We need it to stay there for as long as we possibly can, and we need to hold 7,750 on the FTSE. But Jay's going to go into some of the technical analysis bits and pieces and charting on the markets in a few minutes. So volatility, guys. Firstly to you, Jamie, what are you thinking about Friday? Saw the markets. Were you with me going whoop whoop cheering on Friday with the markets going up, or were you like not so sure whether or not we deserve being up at 8,000? What were your thoughts on Friday, mate?
Well, a bit peculiar, really. I think that, like a lot of people in the last 6 months or so, I had a really good run. And I happened just in the last couple of weeks, I've been lightening my load quite a lot. So I ended up going into Friday sitting on quite a lot more cash than I usually have. So it's never nice to see the markets get a bit frightened of something. And, you know, it seems to be short term at the moment, what they're frightened of. But from a personal point of view, I've actually on a relative basis, I did okay of it. So I wasn't really, sad the following week when it came off a bit, because I managed to pick up some things that, they looked a bit irrational for a couple of days.
Okay, I think that's fair enough. I think you should always look to rebalance when markets are looking, a little bit rich if that's your personal viewpoint, and not to follow the consensus. So that's all good. But what were your thoughts, Jace, on Friday up to now? What were your thoughts when the markets were popping?
I would say sort of, we haven't corrected in the S&P hasn't corrected in a long time, has it? It's not done a normal sort of 5% retrace since. Well, it hasn't done one this year, and it's quite a while since it has. So we've been expecting it. I just think that it didn't matter what the news was. The markets were just sort of ready to sort of digest, and the markets have been digesting for some time under the surface. You might have noticed the Russell stocks just starting to hold up a bit better. UK small caps have been kind of outperforming in a way. There's even today, I think. Let me have a quick look. Small caps yesterday did okay as well, didn't they? But yesterday was what we call a lockstep down day, to quote the great Tom Basso, where everything just goes down. I call it widespread day, and that's the sort of day where everyone feels it, isn't it? But I mean, it's just business as usual, isn't it? Really, it's there's nothing really spooky in the markets. Really, it's just a little bit of volatility. What we haven't had in quite a while, really. It never feels good though, that's probably the main thing. It never feels good when that happens, when all your stocks go down together. But it is what it is. If you trade the markets, you've just got to get desensitized to those days, I suppose.
I agree with you. I think the problem with Monday was across the board, as you say, in lockstep, ranging from, I think which market was it? The FTSE 250, 1.8% fall, all the way through to FTSE AIM, UK 50 index, 1.92%. So that was the range. The lowest fall was 1.8. So everyone was going like that on Monday, going, the weekend. And that's what geopolitics can do. It's have nothing to do with your own market. It can be what's going on elsewhere. And the markets, it's like risk off because we're not sure how this is going to play out. So we've got to be prepared for that. And also, I think, given where we've been over the year to date with the market, it's a case of, okay, on Monday, the markets went back to 7,820. We've been waiting all year to get to 7,800, right?
Yeah.
So the fact we actually fell back, as Jamie said, was like, I took a bit off because I thought it was rich. We've only gone back to where we were a week and a half ago.
Yeah.
We've been praying all year to get to 7,800. So it's no great shakes, but I think everyone's getting a little bit too short-termist, and a lot of people have become more trader orientated rather than investor orientated, because of the supercomputer that is a little phone in the pocket. So we'll see how things play out, but I would like to see a little bit of a calming situation before the end of the week. And given the fact what I was saying in the last podcast, that essentially we've got all this additional monies coming into the market because of the new ISA season. I was hoping that this would be the month where we held on, got the 8,000 and held on to it. And we've got less than 2 weeks to do that. And I'm still fingers crossed that that's still a possibility, unless we get some data out for inflation saying it's going back up and oil spikes. So we'll see what goes on. But I'm conscious that we've not fully introduced Jamie yet. And I've got his Twitter handle here. So those of you that haven't found him yet, his Twitter handle is at Jamie C W. Some Americanism there, I think. And Dubya. And he's going to explain why that's a W instead of Ward. But ladies and gents, over to you, Jamie, to introduce yourself to our global audience, please, sir.
Hello. Yeah. So the Twitter handle. I used to work at a place called Williams de Bro as an analyst. And when I was building my Twitter handle, I did want Jamie C. Ward, but I think someone already had it. Or I think I wanted Jamie Ward and someone had that as well. And I used to work for a guy called Jim Wood Smith, who's retired now. And he always used to call me JW. And I used to call him JWS because if you remember the second George Bush president, middle initial was W for Walker, and he was known as W. So I got the nickname W off Jim, and I called him WS. He called me W, and that's how it ended up like that. But so that sort of gives you some idea of my background. I started in the industry in 2006 as an equity analyst, mainly for the first about 7 or 8 years working sort of investment management arms, doing the equity research for various investment management arms. It's funny you're talking about markets sort of hitting 8,000. Because I remember being interested in markets when I was a teenager. I remember in sort of late 1999, markets hit something like 6,860 or something. So 1999, it's a long time ago now. And me joining the industry in 2006, and it was basically just this relentless positivity in markets when I first joined. And then the great financial crisis hit. And I don't think we ever actually managed to breach the 1999 level. So then you watched it come clattering back down, and it took until probably 15 years into my career before we even got back to the 1999 level. So the fact that we're talking about 8,000 now is all great for most people. You know, it's not a bad thing at all. So yeah, as I say, I started as an equity analyst 2006, did that for about 7 years. And then I helped a guy set up a hedge fund, but we never managed to raise enough capital to turn it into a viable business. So I sidestepped into long-only equity management. I ran something that was called the Oriel UK Equity Fund, latterly became known as the Crux UK Core Fund. Crux is now owned by Lansdowne Partners. 2.5, 3 years ago, I took a sidestep. Well, it's not a sidestep, actually, it's a promotion. And I became head of investment solutions at AJ Bell. So I was responsible for the sort of asset allocation of their entire core investment line, which was 9 funds and a load of model portfolios. And then back end of last year, I decided I wanted to go back to what I think is, to be honest, the real investing, which is looking at a business, deciding whether you like the business or not, and taking a view by investing in it. Like investing in stocks and shares has always been my sort of passion. So and I sort of moved away from that. So I've come back to it. These days, I'm mainly writing for SharePad, doing a few bits here and there, and more or less being a full-time dad.
Nothing wrong with being a full-time dad, mate. I was doing that when the missus returned, or the boss returned to work after 10 months, and I loved it. She's now 16, mate. You know, best years of my life, I think. But yeah, I want to go back a little bit, if I may, mate, regarding the equity analyst side of it, because Jason and I we're the non-professionals, and we're constantly analyzing stocks. But there's the different tack that the professional takes to what the I'm not being disrespectful to Jace or to myself when we say we're unprofessional, or non-professional. But you're the professional. You've been there. You have to work within certain parameters where, you know, Jace is a surfer. You know, he's got free will. I've got free will. We go about and we select any stocks we want. But you guys are ordinarily confined to a certain sector or market capitalization.
Yeah, it was really interesting. You are quite restricted, particularly when you're working in investment management and you've got those big client banks, because particularly as regulations are sort of tightened up over the years, it's become harder and harder and harder to invest in anything that's not very, very liquid. So the kind of pool of investments has shrunk. So if you weren't careful, you were, you know, at one point I was running consumer goods, utilities and support services at Investec, one of the places I used to work. So if you weren't careful, you'd probably only look at about 9 or 10 companies, and that would be your life. The thing about being a professional analyst is you had 40 hours a week where you were basically just paid to look at company and accounts. So whilst you had those 10 companies, they didn't take up all of your time. So if you were so motivated, and I was, you could look around. So it was your own sort of intellectual curiosity that led you to look at other smaller businesses or look at different areas and allowed you to think about things. And then it got a bit more interesting for me when I became a fund manager, because we had a mandate. I mean, we were basically looking FTSE 350 at our stocks, but we could be much more imaginative with what we were doing, and I could look across any sector, and I could really get into the weeds on a business. Now, I mean, it's a wonderful thing being a professional analyst, because, you know, if you are passionate about investing, I was basically paid to look at businesses all day, and that's the thing I enjoy doing. The downside is various compliance things and things like that actually make it very difficult to participate yourself when you, as a private investor. So you end up being somewhat aloof from it. So I quite like the situation I'm in now, where I can have my own personal book and I can do what I like, but I've also got the kind of the background of fundamental analysis that I did for 18 years.
Brilliant. So if you have to choose between being in the situation you are now, or an analyst, or a fund manager, you're happiest now as a dad and and a private investor.
Well, the dad thing, yes. I think
that's the right answer, by the way. The missus is listening through the door there.
If you multiplied my personal capital by a number, I think I would be very happy just doing that personally. The best job I've ever had was being an equity fund manager. That was my baby. I loved it.
Cool. Love that. Okie dokie. I'm conscious we've got Jason sitting there. Jason, we've got a professional with us, mate, and
you know him, mate.
He's hiding on Twitter. He's got barely any followers. So anyone that's not listening,
I don't post
not
much,
listening
though.
to me,
well,
not listening to me properly, or listening to Jamie properly. Ex-professional fund manager. The Twitter handle is @JamieCDUBYA. Currently got 162 followers. That's a disgrace. We need to double that in the next 2 months or so to at least 300, and we'll move it on to 500 by the end of the year. Okay, just click follow on Twitter. Right, Jason, do me a favor now, mate. Go back to what we were talking about at the beginning here. We're going to come back to Jamie in a minute, and we're going to get his first stock, and just show us the volatility on the FTSE, please. That's been happening over the last few days, and just calm some of the people down that are chilled and as relaxed as Jamie is. He's there rocking the baby at home, going, markets moving 1.8%. I don't care, right? Tell people why they should be calm. Look at the support levels, etc.
Okay.
And where they should be looking for a little bit of further good news, maybe, if there's some good news to be had. And we'll come back to Jamie in a minute.
So I'll share my screen,
mate. Go for it.
I usually do these for ShareScope as well. So I'll do a chart in focus on the ShareScope articles once in a while when there's some big levels in the market. So always have a look there. But have you got my screen up there? Yeah.
I've got your screen now, mate. Yeah. Thank you.
So I'll just do a big picture run through these markets, and I'll start. You know, I do them in an order. I kind of Dow theorist, so I come from the transports first, and I'll just put it on a weekly chart just to clean it up a bit for you. And
okay.
So basically, you know, transports in the US is kind of seen as the leader, and the transports is basically still going sideways here. I've drawn a little cheat level here in, but you know, it is what it is. We want the transports to set up really and step up, but you know, just going sideways forever and a day. The last 2 years, the transports, yeah, you know, up and down, but basically sideways. Let's go through to the industrials. Industrials. We broke out of this big base. You know, this was the bear market, and then we basically started to sort of go sideways and consolidate. And we've had this big breakout. So this is the first retrace. This is what I want people to focus on, because, you know, even if this fails, I will trade toward, you know, this would be a sweet spot in every bull market. You know, even if it fails, if you go back over time and look at every first thrust out of a bear market, the first pullback it will look very good. If you did it in stocks or if you did it in markets, whatever product you want to look at, you know, this is what you want to be looking at. And it never feels good when it starts to happen, you know. The psychology behind this, I suppose, is a lot of people don't believe that markets can go up after they've dealt with it, you know, a couple of years like we've had. When they do start to go up, they tend to be late buyers, and then they tend to get their fingers just, you know, you dangle a few toes in the water and you lose a few. So that's kind of, you know, that's kind of the way I tend to describe it. But this is a first retrace. We're looking at a weekly here, and yes, we've got some huge distribution. There's a lot of scared investors out there, but you know, that's the Dow 30. This is the S&P. You know, came off the lows. Basically, you know, big picture charting, simple Dow theory. You know, active low, higher high, first retrace, and then new highs. And basically, the thing what I always teach is watch the strongest markets. Don't watch the weakest market and say the weakest market is the leader when you're in an uptrend. You know, watch the strongest market coming down to some normal areas and wait for that to sort of land, because you know your strongest markets are the ones what are going to dictate whether this is going to, you know, turn out to be the first retrace in a new bull market. And I say new bull market, we haven't even broken out really in the UK, have we?
No.
But yeah, you know, that's garden variety. You know, just for anyone who's wants to just back test this, just go back into the, you know, coming out of the US election and that first retrace, off we go, you know. Nasdaq 100, first retrace since new highs. Yeah, tech led. Do you remember how everyone was so bearish on tech, and tech led this new
yeah, and
bull
up
market?
to early parts of 2023 onwards, and then it just popped.
Yeah,
And they've been talking about Magnificent Seven since then, and they've gone a bit quiet now. They call it Magnificent Four.
Yeah. So this is the Russell. It's only just, you know, popped its head out of this base down here, and you know, it doesn't look great, but you know, it's the Russell. It's kind of lower on the risk fountain, isn't it?
Yeah.
DAX, leader of Europe, clean breakthrough. The first retrace was here actually, so we're on for a second retrace on the DAX. You know, I call this a zone of interest. Not really a deep retrace, but this is the first, you know, starting to be the first retrace. 4%. You know.
Okay.
FTSE 100, I've basically been going sideways, you know, since I've been sat in the seat. So
yeah,
it is what it is. It's what it's made up of, as we know. You know,
well, that's just what Jamie was just saying, wasn't it? It's gone nowhere in all the time that he's been in the market, or even since he was a teenager.
Yeah. Why?
Which is why lots of people are now looking at other markets, Jace, instead of the FTSE.
Yeah, I mean, I understand that, but there is a danger in that as well, because you know, people start to believe that, you know, markets can't trend, don't they? And this has been, you know, these are actually very big moves, you know, but then it's kind of, apart from the pandemic, it's just not really had any trend in it for a long time. It's not a trendy market though, is it? 250 on the other hand is. So
yeah.
Got to remember there's a lot of yield in the UK as well, which you don't see in the price charts.
Yeah, it's very true.
Into sort of more where I do business, you know, 250 stocks, but more so small cap stocks. Yeah, you know, we're just going sideways still. We've been going sideways for over a year. So, you know, it's easy to be doom and gloom on these things, but you know, we haven't missed a bull market yet in the UK. Everyone's sort of get this feeling that people think we've missed it. We haven't even started one, so and I'm not saying that
break out, mate.
I'm not saying that we're going to launch into a ripping bull market, but I do know that after bear markets, bull markets very common. so I'm always going to be the positive person on this. I can always find enough stocks what are trending to keep me happy. And then small caps. There's not much point me looking at the AIM market, even though I do trade a lot of AIM stocks, because as you know, the AIM on the whole, it isn't really, you're not going to find many great stocks in the AIM market, but it's just going sideways here. So small caps have actually done quite well recently, I would say. There's been a lot of digestion, and yeah, I just think we're coming into. I get excited when we come into these areas because I know that there's going to be lots of stocks what are just refusing to go down and are basing out, and there's going to be lots of stocks what have broken out and they're going to do retraces. And that makes me happy. If you trade stocks, that's what you want to see. But as you know, psychologically, it doesn't feel great, does it? When it all happens in a couple of days. So personally, my portfolio was at all-time highs on Friday in the history of the world, all-time highs for my portfolio, and I was down 2 point something% yesterday, so back up again today. So it is what it is, really. But yeah, that's a big picture view. Just zoom those charts out and don't get caught up on the intraday. It would be my
No, I appreciate that, mate. Thank you. No, thank you for doing that and showing all those various charts. I think to reiterate what Jamie was saying as well, is about the psychology and staying calm and using your words, your technical word, Jace. Zoom out.
Zoom out.
It's one day. Out. It's one day. So yeah, no, really appreciate you sharing those charts, mate. Really, really, really important to analyze and think about that. And if the fundamentals haven't changed regarding the companies that you've looked at, we've got a professional here with Jamie, and he will say the same thing. Fundamentals don't change overnight.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
So I'm going to just talk about quickly one stock that piqued my interest today before we go to you, Jamie. And this one here has changed its name in the last recent time. And it's now called International Distribution Services. Did you guys see the news regarding that? Formerly known as something else.
Yeah. No, what was that thing?
Part of Royal Mail, wasn't it? So it's now the distribution side of it of things. It's now called IDS. And basically today it's popped 28%, Jason. I'm not sure if you've got the charts there, but the Czech billionaire Daniel Kretinsky has made a takeover approach for the Royal Mail owner. And essentially he already owns 27% of IDS through his vehicle Vesa Equity Investments. And now there's reports by Reuters and the Financial Times that he's been considering a bid via his corporation parent called EP Corporate Group, Vesa's parent company, and confirmed that a non-binding indicative proposal that has been made earlier this month. So it's been mailed earlier this month. We're in the 17th. We're finding out now about it. But the shares have been edging down for the past year or so, and were nearer to low £2 as of today, before this news came out, and then subsequently popped. So my thinking straight away, being a conspiracy theorist, is maybe Daniel was a bit ticked off with his 27% of his shares in IDS being so low. So he's told his mates to say, look, tell them that I made a bid for it. And what happened? The shares popped. But it's been rebuffed, if that is the case. And we will see what else gets said going forward. but given the fact that it IPO'd X amount of years ago, and it's still below, was it 20? I think it's 2013. I've got in my head that it was IPO'd or listed, and everyone else bought the shares and said it was cheap then. It's still below that price of £3 odd. So we'll see if it gets taken out. Will it be allowed to be taken out and go private, given the scale of what it's meant to be, as in formerly known as Royal Mail? What are your thoughts on that, Jamie? I thought there were certain things that couldn't be sold. No, I know
Well, I
it's
think,
listed now, but
yeah, it doesn't include the post office though. Royal Mail and post office aren't the
it
same
doesn't.
thing.
It doesn't. It doesn't. It's a delivery side.
So
Yeah,
it's literally just like blokes in vans and distribution centres. It's not like the post office.
blokes and ladies, mate. Blokes and
Sorry.
ladies.
Yeah, of course. We've only got post women around here, so I don't know why I said blokes. But yeah,
I used to have a post lady. I used to have a post lady.
it's been a dog of a stop. It listed
Fairness, yeah.
2013, like you said, and I think it was like £6, and what is it now? 2. Compared to 18 months ago, it's probably half the price it was. So if it goes out at this price, if you've owned it for anything more than a few months, you're down. So you're probably not that
Yeah.
bothered. I don't think there's a yield there. As a business, it's never been great for the same reason that what was British Airways was never a great business, which is you've got huge pension issues. I imagine. I've not looked at the accounts for a long time. You've probably got quite heavily unionized workforce, and can't say as I blame them, to be honest.
Yeah.
It's not an attractive business. Whatever this Czech guy can see in it, I don't know exactly, but maybe he thinks he can extract some monopoly value out of it. I'll be surprised.
Yeah, it's an interesting one. Is it one that you've looked at in recent past, Jace, on your charts, other than to say avoid it?
Yeah, it's not really my wheelhouse, that one. It's back from since the IPO. It's just basically it's kind of deep sea fishing for me, that one.
So you come up with some terms, you mate. Thank you for that one. Deep sea fishing. I'll have to make sure someone edits that for us. Right, I'm going to go firstly now to our great guest here. For first time, he's dived into the deep end. He's doing some deep sea fishing for us as well. Jamie Ward, you're going to share with us your first stock, sir, that you're going to introduce to the world, that you want to talk about, give your reasons why. Jason and I will rip it to shreds and tell you that you're an absolute, star for picking it because it's a genius pick, or we'll say something otherwise. But no, we're just going to we'll be gentle, mate. It's your first time. Come on, tell us what you got.
I suspect Jace probably would. Well, I won't rip it apart, but he would say probably not now, because I think on the technical point of view, it doesn't look great. For people who don't know, where actually one of the best places you can find me and my opinions on things is actually at SharePad. I write fairly regular articles for them, usually about how I think and the companies I talk about. And one of the companies I talked about this week in my article, which was called Safe as Houses, I think I called it, which is about the economics of UK construction. I talked about 2 companies in there, and I'm going to talk about one of those today. I don't own this company, but I am tempted. It's a pure out-and-out value play, and the business is Speedy Hire. SDY is the ticker. Speedy Hire has been going sort of 40 odd years. I think 1977 it founded, and it's basically a bunch of sites all across the country and Ireland with stuff you can hire that is useful mostly for things like construction. So it's anything from access to machinery to power, all that kind of thing. They do have a small subsidiary in the Middle East and Kazakhstan that's related to the oil and gas industry, but it's much, much smaller than the main core. The way you think about equipment rental businesses is they're there to provide you with the marginal need for equipment. So your big construction firms will have an amount of construction equipment, and they can service a certain amount of business with that construction equipment, or they will have suppliers who can supply them with that construction equipment. But when construction demand really begins to start moving, that's where the rental market comes in, and that's where the economics can be attractive or unattractive. So when the construction market's not doing great, and in the UK it's not doing great at the moment, mostly probably because of interest rates and the knock-on effect of the housing market, it tends to depress the profitability as measured by sort of returns on capital for a business like Speedy Hire. And it's not just Speedy Hire out there. There's a few like VP Group and those sorts of businesses. When you have a period where housing is doing very well, housing volume is doing very well, not prices, volume is doing very well, the demand for places like Speedy Hire is much higher, and that marginal increase in the demand makes them much more profitable. I would suggest buying something like Speedy Hire. You want to do it at a low ebb, so when construction's not doing very well, because it looks its worst. The interesting thing about it looking its worst is its earnings are quite poor at the moment compared to where they've been historically, but the multiple on those earnings is also very low indeed as well. So the way I look at it is it's got about 200 million in capital employed, and it's got an enterprise value of less than 200 million, and it should be quite a lot more than 200 million. And so usually, and this is where Jace might not be quite so keen on it, because it's not showing signs of turning yet. You want to be buying this sort of business as the construction recovery begins, and then you should start seeing it in the share price where it starts going the right direction. You get in there and you kind of ride it up. In the case of Speedy Hire, they've got what to me looks like quite a safe 10% dividend yield. So this is a classic case of you also being paid to wait. So right now, I think you're paying probably somewhere around half its net asset value, and you get a 10% dividend yield. And earnings could go a lot higher from here if you get a better construction environment. So that's the stock that I've been thinking about quite a lot recently.
Okay. My first question really is the fact that, we're looking exactly a week ago that the company cautioned Jamie, and it came out with essentially saying that it warned of weak demand and that it hampered its earnings, and financial years came in lower. Like you said, cost inflation, construction demand was a bit weaker. Is this the nadir of 2024 for it? And are you saying that potentially, having put the warning out of the way, we're getting to better times for the market? It's going to get warmer. People are going to start building more houses. People are going to go out to buy more houses. So therefore, we're going to need more. Are you saying that, April, May, June, July, August, Speedy Hire are going to?
Well, I mean, that's part of the caveat. I think they don't have to get better really from here, as long as that dividend is safe around here, and I think it is. Yeah. If it gets worse, then there might be an issue. But we'd be getting worse from a really, really bad base, which would be sort of historically bad. I do think there's a degree potentially of kitchen sinking. So the current CEO has only been in since the back end of 2022. He's only a young guy as well. He's about 38, I think. And he's got this sort of velocity plan where he's got where he's doing what I think is the right things. He's pulling away from areas that are just taking up capital that aren't required. So you may have noticed they took a £2 million hit on a sort of exceptional basis by moving away from the kind of in-store aspect of their B&Q partnership. So you used to be able to go in B&Q stores and just borrow Speedy Hire stuff while you were there. Now you're going to B&Q stores and you say, I want to borrow this, and then it gets dispatched from a Speedy Hire depot. That actually frees up quite a lot of capital and things like that. It sounds boring, but it's actually quite good at sort of improving the business itself.
It's not locked up. It's not locked up in B&Q. It's sitting on your site, and therefore
which is there anyway.
Absolutely,
they're sort of using their own capital, because something like Speedy Hire only has a utilization rate of about 55%. So 45% of the time, the stuff isn't being used anyway. Yeah. So if you've got an additional load of stuff that you also have to sit in B&Q sites, it pushes your utilization rate down, pushes down your margins, pushes down your returns on capital. Yeah. So I think he's doing some clever things that can really free up that balance sheet. And
I like that. I like what you said there about utilization as well. Jace, any thoughts? Any charts? What you're looking at here, mate? And should we be going anywhere near it? I used to hold this a good while back, and it just didn't go anywhere for me. So I ended up coming out with that. I think it was a small loss I took on it at the time. But it's not on my radar at the minute. But I might have to keep an eye on it, because I do like a bit of play on the construction side.
Not traded it since 2012. This one, for me. Obviously, I'm a bit more on. I'm a goal hanger, but where technicals and fundamentals meet. So yeah, exactly what Jamie's saying about. I mean, the pre-tax got axed this year, didn't it? And even the forward turnover looks lower on this one as well. I just think for me, it's got quite a high debt multiple as well. So I would sort of at least see the next prelims drop, and sometimes the ones that are ready to recover, the bad news will post and the stock will gap up, and that would be a good thing to see on this one. Also, another thing I'll say about these, construction related or whatever, they tend to move as a pack. So if I'm not seeing other ones in the sector, I know I haven't missed anything yet. So yeah, it's one of those, different styles. For me, I have seen some construction stocks acting actually quite well, but we will start to see them move as a group at some point if they're going to recover. And as I say, I'm not going to be buying the lows. I'm going to be buying the first base, preferably in the future, if it fits the criteria I trade towards. So yeah, I see it historically sort of low area, deep sea fishing for my style, but I can only say just that high debt multiples are a bit of an avoid for me at this point in time.
Okay,
That's
cool.
me.
No, thank you for that, and thank you, Jamie, for that one as well. I'm going to stick with you there, Jace. If you want to go with your first stock, please, sir, that you want to talk about, and then I'll share one with you as well. See how we get on for time.
So I was just going to do a quick look at. I'll share my screen.
Yeah.
And I was just going to do a quick sort of review of W7L and AT, just the noise around previous results, and more the psychology of sort of holding on to winners. And in my department, I'm looking for true market leaders. So, clearly in the UK space at the moment, W7L and AT have been market leaders for some time for the growth investors. So I just thought what I'd cover quickly is not so much tipping a stock, more a bit more process, because my group, we got involved with these a long time ago. But when you're riding these things, the bigger your profits get, the more sort of emotional you get with these things. So I'm just going to do some real basic stuff. Zoom the chart out, put the log scale on. If you've got the linear chart on, you're probably going to, that's going to heighten your sort of emotions. I work in multiples of risk. I don't look at percent moves. I don't watch my P&L go up and down. Points about W7L, it was coming towards the results, and a bit of read across from some US stocks. And a lot of people just basically threw this stock up out of their portfolio just through fear alone. And the way a trend follower approaches this, there's a really simple way of solving this problem, the emotions of holding winners. I don't sell on the way up. I only buy more of what's working, and I trail a stock behind it. So I'll just show you a screen what has got some really generic trailing stops. One's 1%, and this is a 100-day low. And what I like to say is, a trailing stop is worth 1,000 intraday predictions, because the most money I've lost in the market was on a winner. I think I've covered it before. I think it was AMS, Advanced Med Solutions, back in probably 12 or 13. And I sold this like a hero over here. And, thought I was doing everything right. And, just news days. I always say news days are noise days. And if you find yourself selling on news days, it's probably going to be an emotional sort of reaction to something, and a simple trailing stop will save will make you a lot more money by keeping you in the stocks, what just have a bad day. And I just wanted to just translate that over to AT yesterday, because the same thing, any growth investor who trades trends like me will have been in this very early. So this is a big position, and the bigger the position, the more volatility has on the portfolio. The more you want to strangle it with a lock profit in and all these things what people do. But when you look back at all the greatest trends, you didn't have to strangle any of them, with a tight trailing stop. They need room to breathe, and this traded up towards its results as opposed to W7L trading down towards those results. And they were both pretty much what we expected. So this had a bad reaction, and like we joke, it's trading where it was trading a couple of weeks ago. It's just the same again. Zoom out of the noise, and just if you want to hang on, if you want to ride a trend, and catch a big, and that's what we all want to do, really, catch a big winner. You've really got to just give them a bit more room, zoom out a little bit more, a little bit less trading on intraday news. And, if the news is bad, it will stop me out. Maybe not today, maybe not, maybe tomorrow kind of thing. Many times it will just be volatility in the primary uptrend. Put a weekly chart up. What do we see? So yeah, that would be sort of not so much a tip. It's talking about two stocks we know very well now, but yeah, just they're like a slippery bar of soap, these things. So a few simple rules will just help you with that.
No, thank you for those two, Jay. I think the interesting thing is how many people I know and I think Jamie sees a few as well, that hold W7L and have held it for quite a few years. But I did notice last week that it did get sold off. There was people selling off out of the stock or trimming, just from the sheer movement of the share price. No one on Twitter was saying they were trimming it, by the way, or selling it, as we know. They never mentioned that sort of stuff. They only tell you when they're buying it. But you could see that from where the share price is moving, that people getting a bit nervous. I'm going to lock, I've made a lot of money on it, so I'm going to lock some of that in before the result. And then the results came out, and they were reasonably good. AT is a stock that just completely, I've missed completely that stock. I've not looked at it ever. And every now and then I see it being one of the highest rises again. I'm going, why have I never looked at that particular one? I really don't know. What about you, Jamie? Have you looked at W7L or AT in your time of looking at some of these?
I've looked at them both.
Stocks?
I mean, I missed them both, which wasn't great. W7L's pretty interesting for people who I don't think we've actually mentioned its name. We've only mentioned its ticker. It's Warpaint.
Warpaint.
So basically,
it's
two guys who own just over 50% of the stock, and they have a makeup brand because they've worked in makeup since the 80s. And all they do is, I say all they do, it's more technical running a business than saying all they do, but all they do is they get people in China to make them some makeup, they slap a brand on it, and then they sell it wholesale. And where they get their value is creating brand value. So making the Warpaint a valuable brand. And in some respects, and it's a bit of you have to squint a bit, but it looks a little bit like Fever Tree. Very little capital. Get someone else to make it.
Don't mention that word on here, mate. Come on.
Sorry?
No, but but you are spot on. So someone mentioned that to me as well, in passing, and I just didn't get it. And it's a similar thing with Fever Tree, because what's your cost? What's your outlay? Very little. It's like drop shipping.
You're doing
isn't it?
the thing
Send
that's valuable. The brand. You're getting everyone else to do the rest.
The brand. Absolutely.
And it's pretty good, the more it's really easy to scale when you're just running a brand. So, I mean, I think recently in the last year or so, they managed to get it stocked in New Look. So that's like 200 stores in the UK. And that if they got a US store with 500 stores across the US, I have no doubt at all that they could ramp up the production and distribution quite quickly, because the people that are doing production and distribution can do big scale. So it's all about getting it into store and getting it in people's sort of radar, like consumers' radar. This is the brand you want. So it's a very interesting business. I've never owned it because it's always looked quite expensive. But maybe I need to take a leaf out of Jace's book and just look at that. This is going up and just follow it. Ashtead Technologies, AT, that one's a bit different for me. Again, I can give it an analogy. To me, Ashtead looks like a Greco looked like 15, 20 years ago. So a Greco was power generation.
I remember it got taken over at a premium, a good premium. Yeah.
Yeah, but a long way down from where they had been. So a Greco, they basically put power generators in TEUs, the shipping containers. And if you needed power, they would ship it to you and you'd plug in everything and then you'd have power. And why they made an absolute ton of money from about 2003 to 2011 is the mining boom. So lots and lots of people were building new mines, and often in places that didn't have great power infrastructure. So if you wanted to build something in Botswana or Mozambique or wherever it happened to be, chances are you needed to pay a Greco an awful lot of money to ship over a bunch of power generators. And they made loads and loads of money. And then the mining cycle turned and a Greco turned. And you're right, eventually it did get taken out at a premium, but it was a long way lower than where it had been in 2011 before the mining cycle turned. Ashtead, the risk on Ashtead Technologies, and there's more than one Ashtead out there, so you have to say Ashtead Technologies, which is what they do is they do equipment rental for subsea stuff. So they rent to energy companies mainly. And it's a growth industry on both ends. You've got the oil and gas end where you've got to decommission all your stuff because you can't just leave all the pipes down there. So you need to rent stuff off Ashtead. And then you've got the wind guys who are frantically trying to build as much offshore as they can, and they need to rent stuff. So it's a little bit like when we're talking about Speedy Hire, where you've got this utilization issue because they're the marginal provider of the equipment and there's always additional demand. Every year there's more and more demand. So they're making really, really good returns on capital. And the interesting thing about Ashtead Technologies is it actually has a very, very, very similar quantity of invested capital to Speedy Hire, but they have 5.5 times the market cap. Ashtead could go on for years the way it's going, for all I know, because I don't know, if there's ever going to be a downturn in subsea equipment rental, because that's not my area of expertise. So while I would look at Ashtead and go, yeah, I can see it's been going up, but I can also see it's expensive, and I can also see the reason why it might stop being expensive. And I know that I don't understand when that's going to turn. So I end up avoiding something like Ashtead. Something like Warpaint, I think I could get on board with, but Ashtead, I'd just be always worried that something I don't understand could change.
Oh, thank you for that. Really, really good point. It's very well made, Jamie. Thank you very much.
I wouldn't be trying to sort of load up on them now because they left the station a long time ago. Would be my point.
Long time ago, absolutely.
Yeah,
absolutely. Right, gents, I'm going to share with you. I'm going to share one stock with you here now. So brace yourselves and get ready to critique it accordingly. Be gentle with me because you guys may want to come back on the show another time. I'm only joking. Just say it as it is. Okay. Right. It's a FTSE 250 company. I'm interested in this company because it utilizes AI and tech within what it does. So it's EMAN Group. It is UK-based technology empowered active management company. Investment management company, should I say, and focus on delivering performance and client portfolio solutions and deploying technology across various different businesses. Essentially, its management is through various investment managers, namely MAN AHL, MAN Numeric, MAN GLG, although that's going to change slightly. I'll talk about that in a little while. MAN GPM and MAN Varagon. Okay. So it's sitting currently at £2.65 per share. The 52-week range is £2 up to £2.79. Forecast PE is 8.4. Forecast yield is 5.3. PEG, which is what sticks out for me here, is 0.2. Return on invested on capital employed 7.7, market cap 3.1 billion. So it's a good size FTSE 250 company. I see this company as a future FTSE 100 stock. Year to date up 15%, 12 months up more than 25%. And this is when it starts to really, get juicy for me. I'm looking at long term now, and 5-year annualized total returns of 15.9, 10-year annualized return of 13.6. So a nice, juicy compounder. So I'm going back, and what jumped out at me here was the fact that in February, they came out and basically said they were retiring the brand. So early February, they said retiring the brand of GLG and merging it with the firm's other teams to advance into the credit market. Now, going back a little ways, you go all the way back. I think it was, I've got my notes here. I think it was, 2012. They bought that side of the business, and I think 1.1 billion in cash and shares, 1.6 billion in dollars. And basically that was the catalyst for the growth of the company back in 2012. But now they're merging it to get back into the credit side of the business. They've got a significant amount of assets under management of 167 billion. So this is a big company. But essentially, we're looking at increase under assets under management for them back in Feb. And there's not many companies out there that are in the investment side that are getting that, especially not UK listed ones anyway. So that jumped out for me. And given the fact that they're now looking to move on from where they were before, I think this is quite an interesting company. And the compounding rate of 15 to 13% over the past 5-10 years, I could see this continuing, which is why I see this as a future FTSE 100 company. And it pays a nice, or will be paying a nice juicy dividend of 5.3% going forward. And it's one I'm planning to purchase at some stage regarding this. And you know what? The other thing I like about it is that it's got a female CEO. Yeah, female CEO. You can't go wrong. Going to be outperforming showing the blokes how it's done. So I'm happy with that.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer via SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe to SharePad today using the Twin Petes promo code, and you can save up to £69. Visit sharescope.co.uk/SharePad for further details and subscribe to the investing and trading analysis and data you need.
Right, I'm gonna go to Jamie first. He's looking very quizzical about this one. So I'm gonna go to you first, Jamie, before Jace trashes the charts and tell me I'm being a moron. Jamie, what are your thoughts?
I mean, I vacillate on this one. It's funny you actually said something earlier. You said I see it as a future FTSE 100 stock, because I was thinking, well, I see it as a past FTSE 100 stock, because it was FTSE 100 for a long time. Funny enough, it's one of these stocks that's looked
all right. Let me add again in the
again,
caveat there. Again,
it's looked cheap for a very long time. People have had a downer on asset management, particularly Man Group, for whatever reason. But the good thing about it is it has paid a big yield. I mean, that 5 point some odd yield is attractive in and of itself. A few years ago, when interest rates were basically zero, you could get 6.5 out of Man Group. It was almost a no-brainer to own Man Group. Being in the profession, funny enough, I do know a couple of people over there, and it always seemed like a pretty good business to me. The negative side on asset management is regulations making it harder and harder to make any money, particularly things like assessment of value, which came in last year or possibly the year before, which is basically you have these 7 pillars that you have to do effectively an MOT on your fund every year, and you have to justify why you charge the fees you charge. That's difficult, and you can see the pressure on fees. That said, if you can continue to have fund managers that have decent performance, you can continue with making sure they don't get paid too much so that you get to retain some of it for your shareholders, then you ought to be able to continue to get assets under management back in. And as long as you can grow those assets under management, I think it's probably a cheap stock. I just feel like I've watched it for 10 years do very little. So maybe that's just a silly bias of mine of not being that interested in it. But it's worth holding just for the yield, frankly.
Thank you for that. I mean, the interesting thing for me is the fact that they came out in Feb and basically said, you know what, core revenue, fee revenues rose, yeah, but overall, the net revenues had fallen by 29%. So despite the 29% fall, yeah, and pre-tax profits slumped 56%, Jamie. Yeah, the share price is higher than it was on right now. Is higher than it was on the 29th of Feb. Right. So already that slump has been gone. Right. Okay, that's passed. We're now looking ahead, and the share price is higher than it was back then. And they're now tweaking things to get into credit markets where there's more opportunities to make more and greater margins on what they're doing now. So I'm thinking, is this a potential for them to just carry on growing? Going forward, and when going back to where it originates from, GLG was former Goldman Sachs individuals. I think it was 3 of them at the time. So they've got that sort of connection around the world with all these different asset management companies. And if they don't sort themselves out, and this new CEO Robin Grew doesn't grow the company, then somebody else will come and buy them out, and it'd probably be an American company, because all the different connections they've got regarding all the asset management companies here. So that's my thinking. We'll see if I'm right. Jace, go on, give it your worst, mate.
Well, for me, obviously, it's kind of, I'm trading stocks in a sort of trend following manner that can make, once they've made it to the 250 or the FTSE 100 especially, that's usually it for the aggressive trend. And then they sort of turn into I call it an ex-growth stock or whatever. But this is for me, this would be trend following the trend follower, because Man Group is I don't know, I'm not familiar with it anymore, but I know I learned a lot about time series and cross-sectional momentum from is it Alan Lederham or something? The guy who used to run some of the strategies. But yeah,
I don't know that
they're heavy in trend following, I think. And for me, it's just for me when I get involved with FTSE 250 more efficient stocks like this one is, it's going to be more on a shorter term swing basis. So I'd probably just swing it for a shorter move. It's never going to be a high growth aggressive stock, but yeah, I think they're the best out there in the field, aren't they?
Yeah, they are. They're one of the biggest hedge funds in the world, apparently. And you're looking at just compounding 13% for the next 10 years. If you have just one of those in your portfolio, you can do what you want with the rest of them. And as Jamie said, you're getting 5% for sleeping, getting paid while you sleep. As long as the share price doesn't get hammered by some sort of regulation, as Jamie said, then you should be all right. But yeah, so I'll be looking at that going forward to just put a little bit of a wedge in there for 13% compound. Sorry, go on, Jamie. Sorry, Jace.
No,
I would add on. Sorry, I would add on that if anyone wants to learn about cross-sectional or time series momentum, I think Man Group have a YouTube, and there's some fantastic content from this company on how it's done. So just a little pointer there.
Cool. Thank you very much. Jamie, you're going to add something else, sorry?
No, I wasn't.
Okie dokie. Right, we're going to quickly, I'm conscious of the time here, gents. I'm going to quickly go to your second stock, Jamie, if you wish, and then I'll quickly do another one, and then we're going to call it a wrap.
Well, this is from another one of my SharePad articles from the previous week, which I can't remember the title of, I'm afraid, and it was Frontier Developments, FDev. Again, another pure value play. Doesn't tend to be my wheelhouse, these pure value plays, and this is actually one that I do own now. Effectively, they are a business that develops and distributes computer games. They were founded back in the early 90s by a guy called David Braben. The problem they've had is they've grown their cost base quicker than they should have done because they thought they were going to develop. They were developing more successful titles than they were. But the reality is they've actually got some quite good intellectual property in that business now. Their net cash, their market cap is about 70 million. As recently as a couple of years ago, they were well over 100 million in revenue. And if you could easily see if they have another hit on their hands, or they learn to monetize their current titles a little bit better, where it could become a really quite good business. And if you could tempt David Braben into selling it, then I think there'll be plenty of buyers out there just for their IP and at a level higher than that it is now. The thing that really piqued my interest originally is it IPO'd 10 years ago, more or less exactly, for less than £2. 3 years ago, they were 35 quid, and they're now £2 again. They are a bigger, better business now than they were at the IPO, and they're roughly the same price. They're not as good as people thought they were when they were 35 quid, but I think they're better than £2.
I love that short, sweet synopsis. You missed the bit out in the middle, though, mate, where it went almost down to £1. It's bounced. Yeah. It bounced up a bit of a way since then. And bizarrely, this is the thing about markets and individuals and psychology of people. Everybody, well, say everybody, so many people wanted to buy it at 20 quid and 25 and 30 quid, right? Every man in his whatever was on Twitter talking about FDev, bought it, added. Not so long ago, it was nearer to £1. Nobody wanted it.
No.
Yeah, and now it's at £2. It's getting it's getting a few more people that are liking it. But the thing for me with FDev is it needs that constant supply of hits, does it not? If they develop something and it absolutely goes global and it's an absolute blockbuster, share price accelerates and goes away because everyone's saying, they've got that one right, they're probably going to get the next one right. However, if the next one comes out and it doesn't, and it misfires, the share price could go back to 150 again, and then people are tentative as to whether or not the next one is going to be a hit. And if it's not, then all of a sudden it's like, give up the ghost, mate, sort of thing. So it's not even. I'm not sure what the right word is here, Jamie. It's not even cyclical, is it? It's a case of either hits or it doesn't.
Well, funny enough, in my article, I did say it's a little bit like a movie studio in that regard.
Right. Okay. Yeah.
They are actually slightly better than that though, because it's all about paid for downloadable content, and if you really grubby microtransactions, which people hate, but people still pay for them, so you can monetize the value of titles for years and years, through additional content expansions and all that kind of thing. Yeah. But yeah, there is a degree of that, and also it's the other thing. It's a bit like with films as well. If you want to make a lot of money in films, just keep knocking out sequels. And that's a lot of what happens in the computer games industry as well.
Right. Okay. So they get the next hit and they make a sequel to that one and they carry on getting all the glitches and bugs out and make sure it's successful. Okay. So how recently did you purchase that one, Jamie?
Since I wrote the article. So right. I think the article only came out 2 weeks ago. So I think it might have even been this week. I'm the father of a 10-month-old. I don't necessarily know what's going on all the time. So I can't remember whether it was this week or last week, but it was recently.
Listen, mate, been there, done that.
I know I paid about £1.95 for it.
Right. Okie dokie. No call. Good call. Jason, any thoughts on Frontier? I know you're not a gamer, mate, but have you looked at the shares? I know you were talking about it and you warned people off it, I think, back in the day. I remember you saying to people, look, what's the word you use? De-accelerating? Was that the word you use? exhaustion,
decelerating. Yeah.
decelerating. Yeah,
Um.
I remember you warned a lot of people near the top. I know that.
Yeah. I used to have 3 followers, and then I had one. So, yeah. I mean, this one's been through our trend screens. I mean, it's really obvious what I do here, isn't it? Um. I just thought to bring this up so you could see it because, yeah, I mean, the turnover's still falling on this one, and that when this thing does get that next hit game, it will show up in the numbers, and there will be plenty of time to get on board it. It won't just go straight back to highs. These things are really slow moving, and I'd say the same as with Speedy Hire. Just let the next prelim drop, and at least it's forecasting better times after that, and just get that bad news behind it, and then it might just come off. I mean, it's already basically, well, it's off the lows, isn't it? But I would say, if it goes sideways from here and it gets that bad news behind it, or and then it's trading back towards some growth, it will build a base. It, you know, Smarter money will start to accumulate it, and then it will start to go on its journey. And yeah, I mean, for me, I'm though when I say I buy the high with no supply, the high is usually a lot lower than someone who's buying it on weakness. So you can see 52 weeks is highs is here, but give it time to base out, and that will come down and meet up with you know when the stock stops falling and starts going sideways, 52-week highs will come in, and it will press against those, and it will look a lot more interesting to me. At the moment, the numbers are negative across the board. I just think these things, I'd have to, how do I put it? There's thousands of stocks out there. I'm going to be waiting for when it's actually leaving the station for my time frame, I suppose. That's the best way of describing it. Different styles again, though. It's always going to be different from different styles.
And that's what makes the market. We've got 3 different individuals here that do things slightly differently. Jamie mentioned film studios, and I'm going to ask you both this question, to you, Jace and Jamie. Did you or anyone go to the cinema to watch the recent blockbuster films Barbie or Oppenheimer or Dune 2?
My
Jamie?
wife saw Barbie, I think, at a baby and parents screening one Thursday morning
Right.
about 4 months ago. She enjoyed it.
Okie dokie. Jason, did you go and watch Barbie? I know you're a big fan.
I can't remember the last time I went to the cinema.
Maverick, that
Right.
was my last time.
The reason I'm asking that question is because my last stock, and I'm conscious that we've been on here for a little while, is Everyman Media. And it's a upmarket cinema chain. And basically, on Tuesday, it released its data, which showed double-digit rise in revenue and profits. Revenue of 90.9 million, up 15%. Adjusted EBITDA of 16.2 million, up 11.7. Most importantly, everyone knows how expensive it is to eat in a cinema these days. Food and beverage spend per head, as in one person, was up to £10.29. What are they buying? Burger and a pint? I'm not sure. Up 10.2%, and average ticket price was up 3.2%, and the market share was up up to 4.8 from 4.5%. Gross cash of 6.6 million at year end. Still got a bit of net debt of 19.4. And the reason I'm talking about this is because we've got a few films coming out later in the year, which could do some good. But it's been an absolute dog of a stock for 10 odd years, despite other companies going out of business or reducing the number of cinemas that they've got. And I'm seeing the possibility of them actually getting to the point where they accelerate going forward. They're going to open a few more cinemas, and I think there's a possibility that they start to grow over the next 3 to 5 years. It's sitting on a quite a lofty PE, doesn't pay a dividend. The 52-week range is 50p to 69 pence, currently sitting about 57 pence. And it's, for me, it's one of those, I'm not going to say it's like a Hollywood Bowl thing. It's where people are doing the spend and spending time with family on in an inexpensive way. And occasionally we'll go to the cinema. And if the right film's there, we'll do okay. Because there's other things to do at the weekend. But cinema is quite a nice, relaxed way to just chill out with the two of you, or group of friends to go and watch a particular film. And I just see this as a lower risk way of investing in the consumer discretionary side of it. Going to the cinema, as long as we don't get another viral outbreak or something like that. But so that's my little stock. Only a market cap of 53 million. It's only Tiddler, down 8% in the last year to date, and 8% over the last 12 months. It's sitting there, and I'm hoping that they can start to just steadily grow going forward. And Dune 2 is out still and doing reasonably well for them. Paddington's coming as well, for those that like Paddington, later in the year. So there you go. I see Jamie smiling. So Jamie, let you go first, mate. Let me know what you think of Everyman Media, ticker symbol EMAN.
Apart from a couple of things, I'm not a fan. I think you've mentioned it already almost as a positive, but I see it as a negative, which is somewhat dependent on what actually comes out. If you have a bad year for releases, it's not their fault if Disney just produces rubbish one year. The thing I do like about it, though, it's going to sound a bit slightly odd. It's the K family. Do you know who the K family are?
I don't. I've not looked into the family, mate, to be honest with you on this one.
They're involved in this now. And as far as I know, they've only been involved in it 2 years. And the K family are rollout specialists. The eldest K family is 94.3, something like that. I think it's Philip K.
Oh.
Between him and his sons and his brother and his nephews, they're responsible for just about any fast casual dining rollout that is a UK domiciled of the past 60 years. So they started out doing Wimpy's, and then Ask Italian, Zzz's, Prezzo, you name it, Wildwood. There's a Mexican one, I can't remember its name anymore. All of them, and they're very, very wealthy. And the reason they're very, very wealthy is because they knew how to take a small business and roll it out nationally and sell it and do it over and over again. They don't always have hits, and they've never done cinemas as far as I know. So they were also involved in something called Tasty Group. That's basically dead. There's about
that company, I
don't know, there's probably like 50 Wildwood restaurant houses in the UK. And the share price, I don't know. If it's down less than 99%, I'll be surprised. It's got a market cap of about 1 million at this point. And they're involved in that. So they don't always have hits, but these people know how to roll out a business. So if they can, what they need to do is they need to make the cinemas profitable on an individual basis. So each one has to be profitable, and they have to just keep rolling them out. And if they can do that, then I think it could be very, very interesting. The thing, I'm just a bit I'm unconvinced by cinemas, and I'm unconvinced this is in their wheelhouse. So I'm sort of lukewarm on it, shall we say?
No, fair points, Jamie. Thank you for sharing, mate. I'll take that on board. I don't own that stock. I mean, I do like the niche that it's in the sense of low cost, go to cinema, etc., etc. Jace, any thoughts on it?
Yeah, I mean, this is a little bit more in my wheelhouse. Being small cap, medium float, I'd prefer sort of low float on these things. Definitely a stock what I would be a trend follower of. I would term it a sloth. So a little bit boring, but it could plod along,
Yeah.
my previous chart I showed, if you look at this chart, I won't drag it up, but you can see that it's basing out. In fact, I'll just share the screen quickly. Be easier, wouldn't it? And this is what we're looking at. We are deep sea fishing again here, but this is 52-week highs, and we're basing out. We're going sideways, and I can see the turnover broke out in the last update. So turnover broke out to a new level. Let's just have a quick look at that using share scope. So we've traded a new high on the turnover, and the stock price is still coming down. So it's a lose less scenario on the pre-tax, isn't it? And obviously still loss making. But yeah, I mean, going forward, is this the prelims? I don't know if we've got the forward numbers have dropped yet, but maybe they have. Yeah, I think you get sort of this sort of action here that if you got another few months of just basing out and a little bit of positive news flow, nobody, the memory of people over here would be long gone. There's only about, in this little area here, there's only 3 days of supply. So it's the type of thing where it is deep sea fishing. I'd rather be buying a stock what's basing out a little bit higher, say under that 100 point. But yeah, as a very early bird sort of stage 1 base, and it's not a growth stock yet, really, is it? Quarter on quarter, maybe.
Not quite yet. No, it's getting there. It's getting there.
But stocks trend as the risk unwinds, as they say. So if you want to have a look at that, just have a look at CSFS. That'd be a prime example of a stock with the risk unwinding rather than it having growth on the table. So yeah, it's more in my wheelhouse. Still a little bit early, but yeah, I see it.
Okie dokie. All right. Thank you ever so much for that. I'm conscious of the time, ladies and gents. So we're going to call it there. Some of you might have been noticing that I'm sporting a little top here from our supporters who are Powder Monkey Brewing Co. And they've supported us last year with one of the prizes for the Twin Peaks Challenge. And this year they're giving us access to their vast array of drinks that they've got on their website. And basically what you can do is go to their website, which is www.powdermonkeybrewing.com, and you can get 10% off all their different beers and ales. So any celebrations you want, go online. There might be a little box they can put Twin Peaks in there, or in the box anywhere else, and you can get 10% off their beers. And if you sign up to their mailing list as well, you can be involved in a prize draw at a later stage, but I'll keep you posted on that. I want to say a big thank you to all those that have given us feedback on the last pod regarding it. And I'm really looking forward to the feedback you give us on this podcast for Jamie Ward, who was at Jamie CDUBYA. So please follow Jamie on his Twitter handle there. Jamie, you're also on LinkedIn, I suppose, aren't you? You should be on LinkedIn, shouldn't you?
I am
You're
on LinkedIn, yeah. I don't know how you have a handle on LinkedIn, but if you search for me,
it'll be your surname, won't it? But won't be one Jamie Ward probably, or maybe a couple. Only you have your little picture rather than avatar.
There is a picture of me from about 5 years ago where I look slightly younger, but it is still me.
Yeah, you've got dad looks now. It's like, I get no sleep.
I've got a cardigan and everything.
Get you a pipe next time, mate.
Yeah.
So, ladies and gents, please say a big thank you as well to my fellow guest here, Jason, who saved the day with me with Jamie at. Find him on Twitter at StealthSurf. That's StealthSurf SURF. Thank you both, gentlemen, for saving me today. Ladies and gents, that's a wrap for Twin Peaks Investing Podcast 125. I want to say a big hello to a certain gentleman that's currently on holiday in Gozo, where you'll probably hear this on Saturday morning or late Friday. Yeah, it'll be Friday. Yeah, it'll be Friday morning first thing. And I hope you can find those cottages and mansions that are available at £100 a night, although it's very expensive there. And I hope to join you at another time in Gozo. Ladies and gents, give us your feedback. Love to hear from you for this one. Leave your feedback on YouTube. Please like and subscribe on YouTube. Please follow Jamie Ward. Please follow Jace at Stealth Serve. Please don't follow me. And please look forward to seeing again in a couple of weeks' time when they're hopefully back in good health. Our good friends. You know when you have a blank and somebody's name goes out your head and you should know it already. Henry Viola Hare and Phil Oakley. Right, that's a wrap, ladies and gents. Take care. God bless you. I'm getting old and see you now. We'll say ta-ra. Bye-bye. See you in 2 weeks.
This Twin Peaks Investing podcast is brought to you in association with SharePad from ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.